Thank you, Ben, for moderating an excellent panel in a very short space of time with expert speakers, and specifically on the need for the development of a high voluntary, credible carbon markets, and the need for international standards to what constitutes good quality carbon credits. So in addition to this, as part of this ecosystem, we also need access to data and technology. And our next panel will discuss how data and technology is used as a tool and a lever to drive decarbonization, increase green capital flows, scale product innovation, and mitigate greenwashing. So I'd like to invite Jonathan Drew, Vice President of Hong Kong Green Finance Association, and also Head of Global Sustainability of HSBC. Thank you.
Jenny, thank you very much, and welcome everybody to panel 3. Let me introduce very briefly my distinguished panelists, Bénédicte Nolens, who leads the Innovation Hub at the BIS. What might that be? Well, I think we're going to find out a little bit. Debra Tan, who runs a really interesting NGO called China Water Risk. We often forget about those risks, so great to have Debra here to tell us a little more about that. Jason Tu, who runs a very exciting, do you still call yourself a startup at Miotech, which is all about data and bringing other solutions based somewhere between Hong Kong and Singapore. On our screens behind me, Olivier Ménard, one of those. We thought about not inviting him because he's recently escaped Hong Kong to move to Singapore, but Olivier, no, you're very welcome, runs the Green and Sustainable Hub for APAC at Natixis Bank. And last, but by no means least, on the screen to the right for everybody in the audience here in Hong Kong, Mervyn Tang, who is, let me get your title right, Mervyn, Head of Sustainability Strategy for Asia at Schroders. Excellent, so welcome everybody. And thank you to everybody for joining this session. I think this discussion today around data and technology, we'll have heard a number of the issues and heard some of the relevance of data and comments about, a shortage of data, a data issue in many of the earlier conversations about taxonomies and disclosures and growing carbon markets and so on and so forth. So on this panel, really, we're going to look at try and dig into that a little bit. When we say data, really what data is it that we need, and what is it we want to do with it, perhaps is the question. And then particularly, how can technology help us with all of those critical issues that others have mentioned, such as accessibility, reliability, comparability, so that it becomes more useful for that ultimate objective of helping us drive more money, more finance, more investment into all of those activities that are so critically needed and need to urgently be accelerated to drive us towards that low carbon, sustainable future. So that's the topic. Obviously, amongst our panelists, we've got a great range of ways in which people play in the data market, from gatherers, processors, distributors, users of data. So we're going to talk and hear from those perspectives. And I'm going to kick off on the screens. Mervyn, if I may. Asset managers, why do you need data? What are you using it for? Or what are you trying to use it for? And are you also perhaps a producer of data sometimes? Mervyn, over to you.
Thanks, Jonathan. Really glad to be here. We actually have to use data for all sorts of different use cases. So we integrate it into our investment process to inform our analysis on risk and expected return. We used it to help us decide on how we exercise our active ownership, so how we engage companies on sustainability issues, how to inform the policies we ask them to apply. It helps us to design products and solutions that help our clients achieve their sustainability objectives. And we also have to use that data and aggregate it to report on our portfolio information that our clients need. Last but not least, we also use the corporate data and ESG data to inform our corporate sustainability objectives. So when we set a net zero target, for example, like many financial institutions have. Now, company disclosed data, I think it's really important, is only one part of the puzzle. So something like carbon intensity, whether a company has a diversity policy, is only one set of data we use, even though it's a very important set. we may also need to use non-publicly disclosed data, so effectively creating data like you mentioned. So using machine learning to scrape Glassdoor reviews so that we get a better idea of employee sentiment. Or we use geospatial satellite data to try and inform us on physical risks. We then have to aggregate that data into specific use cases. So it could be on SDG alignment, it could be on climate risk assessment, it could be on sustainability profiles. And then once we aggregate it, we have to interpret the data. And so I think one of the key things is you may be able to standardize corporate disclosure for comparison, but it's actually also have to think about comparing companies and aggregating that data, creating more data and interpreting that data.
Mervyn, thank you. Perhaps just one quick follow-up, though. Can you tell us a little bit more about, you mentioned a couple of types of data there, sort of emissions data, data about the physical environment. Can you just tell us a little bit more about some of the specifics that you're looking for?
Yeah, so let's take carbon intensity, scope 1 and 2. It's something that we've all seen and looked at. It's probably one of the most common data points. But carbon intensity is not necessarily going to tell us completely what the transition risk a company might face, because they might have different business models where they can pass on that carbon cost. They might have different sensitivity to cost pressures. And so when we're using that data for
因此呢，我们用这个数据来分析它的这个风险的时候呢，我们应用一个分析的
part of that input. We'll also use that carbon intensity data for impact assessment, so how companies are hitting the environment in terms of negative impacts and on climate change. And so we use that data to then build SDG alignment portfolios or climate leader portfolios. And so even with one data point, there can be multiple use cases, and then we have to aggregate that specific data points with multiple other data points and qualitative data points to come up with some of this aggregated data that I mentioned.
Brilliant, thank you, Mervyn. So how corporates impacted by and impacted on, which, Debra, this sounds like a bit of a risk conversation to me, or one of the key risks. Tell us firstly a little bit about sort of water risk. Am I right to say it might be a bit overlooked, but then tell us also how data helps you do what you do.
Thanks for that tee up, Mervyn and Jonathan. I think, today we've been talking a lot about climate risks, right? But I think most of these risks this morning that people were talking about was carbon transition risks rather than water risks. So carbon's what's caused climate change. Water's how you will feel most of the impacts. And I think you could sort of see it over the summer and also last year. It's floods, droughts, too dry, so we have lots of fires, sea level rise, coastal threats, and so on. Hail, snow, glacier melt, etc. So all these are different types of water risks which will have huge impacts on the financial system and also corporates. And these risks are less looked at, and also when they're looked at, most people want to lump them together in one category, like water or physical climate risks, and you want one data score for that number. And that's dangerous when it comes to physical risks. You actually need to sort of look at them completely separately. So even with water, you need to look at flood risks separately, and you need to look at drought risks separately. Now, in terms of data, acute risks, so like one-off event risks, so like typhoons, droughts, floods, those things are better understood, and there's a lot of data around that. And that's possibly because of the insurance industry. So finance understands these one-off risks. I know how to price them. I price them at this premium, and this would cover natural disasters and so on. The more difficult part is really when it comes to physical risks is the kind of like the slow-moving sort of chronic risks. So that would be like the sea level rise, increasing scarcity, ever sort of slightly, every summer it's getting hotter. These kinds of risks that will creep up and compound the acute risks. And that's where there's a collapse in valuation of these two risks when they kind of like clash, the acute and the chronic. And I would sort of say that's also where the data gap is. There are huge data gaps in valuing chronic risks, yet they probably could sink financial systems if we're not stress testing right. And I think, the MA has just done a stress test. We're looking at 32% of Hong Kong's real estate portfolio will be exposed to climate risks, mainly typhoons and flooding and coastal flooding. So, these are huge numbers here. And I would argue that those numbers could be worse if you were to actually stress test to the risks that there are today. So ESG data and all sorts of climate data is really important to sort of like back this.
But can I just drill into that a little bit? Because data, your risk is the sort of exposing yourself to uncertain things in the future. But doesn't data sort of exist in the past? Is there data about the future? So what do you mean about what sort of data is telling you things about the future?
We've always underestimated physical climate impacts. So we're probably tracking worst case scenario climate impacts today. So it's right that you can't really just look at like past data trends to sort of project future data trends. So you have to be a little bit careful there. But I'll throw out kind of like 5 maybe broad areas that you need to sort of consider when looking at physical risk. One is that there's a lot of rubbish data out there, right? If I might say so. And so when you kind of look at this data and you sort of like make huge investment decisions on this data, that could be a problem. So a lot of this black boxing of data doesn't help. Secondly, so that's integrity issue. It's interpretation of this risk. So a lot of times people come to us and say, I've got all this climate data that I paid for, but what does this mean? So it's helping people kind of work through that because there's also regulatory risk overlaid on top of that. And then there's the other thing of this one number scoring thing. I get that investors or asset portfolio managers want one number to score the risk, but that's also very dangerous when it comes to physical risk. It massively undervalues the risk. The other thing, I think Mervyn sort of like highlighted this, is that a lot of physical risk is geospatial. So, and you don't, corporates don't disclose to that level of all my assets at these granular levels. And so that kind of like causes murkiness in that space. And then the other thing is benchmarking. Everyone likes to sort of like allocate their capital over a spread. And so you need consistent methodology measuring this type of risk or even just flood risk. And we don't have that globally. Right. So you kind of like trade off granularity for more detail, basically, and for consistency.
Thank you.
Okay,
yeah,
I know, sorry.
No, very interesting. A couple of interesting, this sort of concept of you need to know where things are to know sort of what's at risk, which perhaps people overlook. And then you also touched on, perhaps in your earlier comment, this sort of scenario analysis, which talks to that future assessment. I'd like to bring Olivier in at this stage, because Olivier, I know you guys at Natixis, you do a lot of this, and of course you're a bank. Tell us a little bit from your perspective about how you're using data in both your risk analysis, in the advisory pieces you're creating for your clients, and also I think how it plays as well in satisfying regulators.
Yes, thank you, Jonathan. Can you hear me?
Yes, loud and clear. Thank you.
Fantastic, it works. Yes, I mean, it's a timely question, because when you think of what happened, I don't know if you did read the press, DFT, and what happened yesterday with some banks threatening to leave the Net Zero Banking Alliance because they worry a bit about legal and financial risks, not to be able to comply with those existing or forthcoming ESG rules and regulations which will be set in place. So collecting those ESG data from clients or data providers for banks is really key. I mean, for us, there are 3 main reasons. One is definitely to comply with the numerous regulations coming on stream, EU taxonomy, SFRD, GSEC, MiFID, Article 8, Article 9, you name it. It is also very useful for us to, for another reason, is that it is allowing us to feed our own technology. You were making a reference to it, Jonathan. We have a tool at Natixis that we call the green weighting factor. This is a tool that links analytically the capital allocation to the degree of climate or environmental performance of each and every financing that we have in our balance sheet. And it is allowing us to measure the temperature of our balance sheet, obviously with the objective to reduce the temperature of our balance sheet to 1.5 degrees. And having that technology in place allows us to track and take some interim targets, so 2.2 degrees, that is the target for 2030, with a baseline today which is more at 3.2 degrees, roughly the temperature of the economy today. How many data does it represent globally when you list all those requirements, and not to forget, obviously, aside those internal data, all the external data that we are using for accompanying our clients in their own transition. So when we design green or sustainability-linked structures, as you do, Jonathan, with HSBC, I see the names of Yasmin at Société Générale, Shaoni at BNP. So we are a group of banks here working on this. We need data, and we need robust data in order to design for our clients robust and ambitious structures, which will allow for those clients and for ourselves not to take any reputational, legal or financial risks. So this is very important. And if you think of all those data, we've done a quick assessment of the amount of data that it represents for the group. So for Natixis or BPC, which is our group. If you take retail, asset management, and investment banking, we are talking about more than 1,300 data points to collect in order to comply with all those existing regulations or forthcoming one, or to use for our clients. So it's a massive effort. And as mentioned by Debra, today those data are relatively fragmented, to say the least, not standardized, but infrastructure is coming, and it will be improved by the regulations which are coming. For example, the CSRD, so the Corporate Sustainability Reporting Directive in Europe, will allow for the creation of a single access point for financial or sustainability information be collected and then to be used. It will increase transparency. It will allow for more standardization and make it easier to compare. We were mentioning comparability. It will be very important.
And Olivier, you've built very nicely on our sort of almost database of use cases for data here, as well as reiterating some of the points around the data challenges. Perhaps just tell us a little bit, how acute do you think these data challenges are? Is it really distorting decision making? Is it causing banks to have to say to regulators, well, we'd like to tell you this, but we don't have the data because perhaps we haven't got it from our clients? Can you give us a sense from your perspective of the scale of the challenge here?
No, I think we are collectively on a journey. We are using as much as we can accurate data, service provider, vendors. We are checking the accuracy of those data, making sure that at the end we have a proper set of data. Can you hear me?
Yes.
I have the impression
No, you're coming across very clearly.
A proper set of data which will collectively allow us to present an accurate picture, not only to regulators but as well to our suppliers, our shareholders, the citizens of the world, and our employees. So it's a journey. We are all together on a journey. Yeah. Regulation will allow us to improve. Investors such as Schroders are putting pressure on the market to get better information and more accurate information. Issuers, they want liquidity, so in order to get liquidity, they need to make sure that the data they provide to the market are accurate. And we, as advisors, as a bank, we try to make sure that the different data that we are collectively using on a transaction are here, and that we protect all different parties to make sure that the transaction that we will structure and arrange will be a success for everybody.
Olivier, thank you. You're very careful and polite with your words, but I'm interpreting words such as journey and concepts as we're trying hard as a very polite way of saying there's quite a big gap and an issue here. So with that, I'd like to bring the conversation back to Jason in the room here. Jason, you were quite open in your marketing that we've all been enjoying at lunchtime, that you're hoping to provide solutions here. Tell us a little bit about that.
Yeah, indeed. I think there are a lot of challenges regarding ESG and sustainable finance, especially in terms of data and the technology behind it. And just now, I think Jonathan asked me whether we should be introduced as a startup or not. We are very proud to be right now probably the largest sustainability data and technology provider. So I can share a little bit in terms of how we perceive the data and technology world is. I think from Meotech's perspective, there are 4 different types of angles that we can look into data and technology in the whole sustainability world. The first angle is ESG, which is more of a financial jargon by now. And I think Olivier and Mervyn have illustrated how financial institutions would use ESG data. But at the same time, where does the ESG data come from? It comes from corporates. So to corporates, ESG is more about disclosure standards that previous panels talked a little bit about. So that's the first angle that we can look at, which is more finance-driven, more shareholder-driven. The second angle that we can look at the data and technology world is from carbon. So the previous panel talked about, which is more climate-driven. And it could be about, for example, energy consumption, could be specifically about carbon emissions reduction. And there's also a lot of standard setting. It could be about carbon trading as well, by the way. There's a lot of a standard setting, but at the same time, it's more focused specifically on carbon or greenhouse gas related or energy related topics. And then that is usually deeply, in order to get that data, the technology needs to be deeply rooted into the whole production or processes, or into different companies' operating lines. And that's the second angle of carbon emissions reduction. And the third angle we can look at is more derived data. So on top of the raw data that we collect, that we report, once is interpreted into, for example, by financial institutions into financial products, then on these financial products, also financial data, for example, indices, ratings, they have meanings or interpretations embedded into it, and then they drive the financial market, the capital market. So that's the third angle. We call it the capital market angle. And there's a fourth angle. After talking about business and economies, there are also individuals. So in the mainland of China and a few other regions, the governments have promoted the concept of carbon for ordinary individuals, 碳普惠, right? So every one of us is a net contributor to the climate change. So how do ordinary citizens reduce our carbon emissions? And how do we, how can we promote a greener lifestyle after collecting the everyday lifestyle-related carbon emissions data or other kind of related to energy consumption data? And how do we promote a greener lifestyle? It's another angle, the fourth angle that we look at. And that is also the 4 different business pillars that we work on as a technology and data company in sustainability.
Jason, thank you. I have to ask you on carbon for individuals. So your data that you're looking for there, it relates to what? Picking up data about individuals' consumption. Is that the primary source to build up an individual footprint?
There are many things that we can evaluate in an individual's carbon footprint. But having said that, to be honest, the technology isn't mature yet because we are all breathing on a day-to-day basis. There are some of the areas where data is more readily available. For example, public transportation, right? Whether by taking the MTR or the bus system instead of driving to work or riding a bike, it's something that is measurable. Transportation is measurable. And in addition to that, for example, the electric vehicle infrastructure or electricity infrastructure, which is more measurable as compared to some of the other energy infrastructure right now. So I think, bit by bit, we have worked on, we have partnered and have developed and partnered with many different partners in different industries, in public transportation, in electric vehicles, in even vegan food consumption in many different areas. On one hand, we help them engage their customers through carbon loyalty programs. On the other hand, there's also carbon emissions reduction, or one step further, carbon credits that we can develop on top of all their business models. Yeah.
And I have to online spending as well?
Yeah.
Is that in the sites?
Yeah, absolutely. From a commercial banking perspective, every transaction comes with a transaction code, right? If you know the details, then we would be able to measure it. So that's also the power of data.
Excellent, thank you. I've already seen we've got a question come in on the iPad. I apologize, I should have mentioned, please, if you do have any questions, I think we scan the code, Tracy, and that'll take you to the Q&A sheet, so please do that. I see the first one's got the word innovative in it, which brings me, of course, to you, Bénédicte, and we're sort of moving into sort of the solutions area now. BIS Innovation Hub, tell us a little bit about that and where data fits in all of your good work.
So thanks, Jonathan. So listening to all of this, right, I was thinking, I just saw Mount Everest in front of me and I thought, base camp. It's just such a challenge ahead, right? So in sum, I do think there are definitely data, right? But the question is where to use them. And so then the question is, do you want to scale the whole thing, or do you just want to reach, base camp and in the first camp and maybe not all the way to the top, right? So from our perspective in the BIS, we are the coordinator for the central banks. So what we do broadly, to put things in context, the BIS stands for Bank for International Settlements. And in sum, we manage the money of the central banks. That's one thing we do. The second thing we do is we create some kind of policy setting across the central banks. The third thing is that is supported by research, so extensive research, and we have research extensively now on green finance, plus we have an annual conference called the Green Swan event, so we do that. And so where I come in is indeed on the innovation angle, is to think about how can you use new technologies for promoting the right outcomes within the financial industry. So again, we are the central bank of the central banks. So the parties that we work with day to day are the central banks, and then the central banks in turn work with banks like yourselves. So from my perspective, when I started, which is 2 years ago, when this innovation hub was started, I was quite keen on being the first to do a green finance project because it is a topic very dear to my heart. But because I said Mount Everest was so big in front of me and I didn't know how to get to the summit, I went like, let's chip away at something highly specific that I know we can do, is high on new technology, and at least can provide an impression to the financial markets as to what is possible. So what we did last year is, in sum, we came up with this idea to tokenize government bonds, and the use case would be Hong Kong government bonds, tokenized, and with green feet attached. So the question is, what's the benefit of the tokenization here? The benefit of the tokenization is that you can actually streamline the whole of the placement process. And incidentally, HSBC and Standard Chartered always act as placing these bonds. It's up to a few years ago was completely manual, okay? So you had to go to the branch and then you had to get your form. And I think you all know that a lot of banks are trying to get rid of their branches. So no more of that. You can't go there anymore unless you really do an effort to try and find that form. So now at least it's online. But the problem is that Hong Kong people like these government bonds because they tend to pay a little bit higher of a yield than the bank actually pays. So savvy Hong Kong people will go to multiple banks and make multiple subscriptions, which the government doesn't like because the outcome is completely oversubscribed bonds, and some individuals have managed to get bigger allocations than others by going to different banks. So in the background, there is a very interesting reconciliation process that can be completely streamlined. So if you're into streamlining operations, you can streamline that whole process. So that was our target. Let's streamline the process through the use of this automation, which we did. But the second aspect was also, while we do that, we can reduce the minimum denomination size. So the denomination size now, because the process is actually quite inefficient in a way, is 10,000. And that's probably because for the banks, it's too much of a manual process still. So let's put the denomination higher. If we automate, therefore, we can bring the denomination down. So our target was to 100 Hong Kong dollars. And with tokenization, to be frank, that's easily achievable. Because as you know, with tokenization, you can actually trade a fraction of a Bitcoin or an Ether. That means you can actually go as low nearly as you would like, as divisible as you would like. But we set it at 100 Hong Kong dollars. We thought that was reasonable. And so in sum, on this prototype, we worked with a couple of startups. First of all, actually with Standard Chartered, it's SC Ventures arm. Secondly, we worked with a startup called Shareable Asset, or Interopera. And the third startup we worked with is All Infra. And they all played a different role. So Liberty, the startup of SC Ventures, was focused on tokenizing bonds. Interopera is more focused on how do I combine that with green. And then All Infra is focused on literally taking renewable energy and making it through IoT devices directly registered on blockchain so that these carbon credits have a provenance and can be tradable. So it's a provenance use case of blockchain. So in sum, we executed all this. The hypothetical was that the proceeds are being invested in renewable energy. And so the ultimate end result, or the UI for the customer here that wants to invest $100, is that we even showed you could reconcile this with, for example, I Am Smart, which means your onboarding can be incredibly fast. Secondly, you can put this into the Octopus app if you want, so that you literally buy this $100 through your Octopus app. And then thirdly, that same app could then show you the transparency of the renewable energy generated, as said, through the tracking on blockchain, that's the one thing that blockchain does do, right? It's an inerasable source of truth. So, you know, that's the use case we showed, but as said, it's quite specific, or you could even say niche. It's not, you know, Mount Everest in sum is still in front of me, and I'm still not at the summit, and I think none of us are. And I think the word collaboration has come up here many, many times. So with this use case, we showed what is possible, and we believed we could play a catalyst role. We have now an extension project, which we call Genesis 2.0, and in a month we're releasing the report for this. For this, we're working with Goldman Sachs, and again also with All Infra, and we're also working with the United Nations. And so the UN is a big believer that you need to be able to move the financing to what they call ex ante, is that when you project finance at that very moment, you should already be able to get the money on the basis of the future carbon credits that you are going to generate. The belief of the UN is that will move the financing to ex ante as opposed to ex post for projects. So this time we've attached to the tokenized bond carbon forwards, you could say. So in sum, the bond buyer has a right in the future to the delivery of carbon credit generated by the project. So that's what we're doing. And then
I'm listening here.
Yeah.
I think everyone would agree Basecamp is a good place to start on your way to the peak of Everest, but I'm getting a feeling you might have gone a little bit beyond Basecamp already. And apologies if I might just slow you down a little bit, because I think you're saying there's the role for tokenization data to get more buyers into deals.
Yes, correct.
And
yeah. And more transparency.
And more transparency. Yeah. So Ashley, perhaps he is still watching. I'm sure he'd be happy to hear what you're talking about. Maybe he has another solution, but I'm sure you're well aligned in that respect. And then there seems to be a sort of a more data-rich transaction, so that even if the buyer on your app of the bond can actually see the carbon impact, and maybe Correct. I can then, Jason will then offset that for me, so that'll offset my, inappropriate spending habits. And now you're adding another financial derivative into this transaction.
Correct, yeah.
Is that?
Yeah, the last one, you're right, and that's why the last one is, or the second one, Genesis 2.0, is not targeted at retail, right? The first one was retail, the second one is more complex, right? Because there's a carbon forward involved, or a derivative, as you call it. So we think that's more of an institutional product. But maybe to bring us back to something simpler, right? Okay. So because as said, I chose something complex and highly specific, but the idea was to show that nothing is impossible here, right? Yeah. So, but in Europe, for example, we have an ongoing project called Gaia, and what that is doing, it is looking at annual reports and using your typical natural language processing to derive green data from it, and its intent is to open source that data. So that's slightly more understandable to many people, right?
Can you give us an example of that? Natural language process, machine reading, what are you looking for?
Yeah,
what are you reading?
So the machine learns, right? So the machine reads these in this case, it's these financial statements, and draws out from it the green data, right? The green disclosures that many are now doing, either to comply with local regulations or to be future-proof under IFRS.
And are you just reading the numbers, or are you reading the words as well?
Oh, reading both, yeah. The idea is to read both and to make this information open source. But I would say that in another center, I manage the Hong Kong center, and that's in the European center. So, and I would think this is just the beginning of the BIS's work on green. So I said we were very much a startup 2 years ago, which is why we looked into these things. But I do think for us, actually, frankly, as the coordinating among the central banks, the key thing is the bank books, right? Is to measure the green risk on the bank's lending books. So this is certainly an area I would personally like to do more work in, but it will take me time to find the right partners to do that work with. Right.
Well, we'll come back to that risk bit, but I just want to follow on the point about sort of reading the future, reading the words, reading the future. Mervyn, I think you touched on this a little bit in when you're reading company reports and you're looking, I think what you were suggesting is for getting an understanding of clients' future plans, perhaps to assess, are they really tackling these risks? Have they got plans? Is that, tell us a little bit more about what you're doing there.
I think so, and I think to take Benedict's analogy, I think Basecamp and Everest, I think we need to know if we're climbing the right mountain, because I think if you don't, there's no point going up to the top if you're if the direction you actually want to go is just past the mountain and you can go the whole way without climbing it. And so I think there's a danger with ESG data and more disclosure at times is that we become so fixated on the metric that we don't remember what the objective of using data is. So take an example, I think, of, let's say Hong Kong SFC have done a great thing, I think, by asking for funds to publish their carbon footprint. It gives a data point for people to look at, and it gives us an idea of the emissions profile of a portfolio. However, I think we need to be able to, I think as a group of stakeholders, asset managers, banks, retail investors, need to understand what that carbon footprint number actually means. So if we take an example of an energy transition strategy that we have, and so this strategy is focused on investing in climate solutions that we believe would help the world decarbonize. So building insulation, wind turbines, solar panels, polysilicon, it can be all kinds of different things that I think many would say these are kind of key to the energy transition. If you look at the carbon footprint of that portfolio, it's actually quite high compared to, let's say, a benchmark index like MSCI ACWI. And that's because it takes actually a lot of carbon emissions to produce a wind turbine and as a manufacturer or industrial. It takes carbon emissions to build insulation. So if we start going down the route of thinking, you know what, I'm going to focus on reducing my scope 1 and 2 carbon intensity regardless of what the implications mean, I might end up just moving away my portfolio away from these climate solutions. Another way I think thinking about it, if you look at the carbon intensity profile of companies across the world, because of I think the sector mix as well as the energy mix of emerging markets, it's typically higher than in developed markets. And so if I, again, just had the blinkered headlights and it just kind of focus on low carbon intensity, I might be moving away my money from EM to moving to DM. Does that really help the Sustainable Development Goals? Does this really kind of help my actual objective of directing capital to more sustainable use cases? And so I think that makes it really important to be able to not just have the data, but being able to understand what it means for your ultimate objective.
Okay, well that's you being smart, Mervyn, because what you're saying there is there's data out there. If it's good data, you've still got to be smart to pick the right data and use it appropriately, which I think is a very interesting point. But you were also raising this point about sort of too much data, and I want to bring Debra back in, not least because I can't resist linking this via the reference to the Himalayas and glacial melt, which I know is one of your favorite, not favorite topics, that's the wrong word, one of your key focuses, Debra. But too much data, is that a problem? Too much of the wrong data or too much unhelpful data, to go back to Mervyn's point?
Right. So for those of you who want to climb up to base camp now, please be careful because glaciers are unstable. You just sort of saw this summer a lot of Swiss guides actually refused to sort of like take clients up there this summer because the glaciers are actually falling apart. And so you would likely have a fatal accident if you kind of like tried to scale the wrong glacier at the moment. So I'm not saying that you shouldn't climb the mountain of data, but I think we need to be sort of like mindful. I think there's a lot of data out there on carbon and there's a lot of data out there on certain types of physical risks. But I would sort of say that one is where the data is there, we're not actually using it properly on the physical side. And I think that's because we're so focused on the carbon conversation. And I think that's necessary because we need to rein in emissions. But we also, at the same time, need to adapt. And that's all to do with water or water-related items. We're likely to hit 1.5 degrees in 5 years' time, right? There's a 50-50 chance, and it looks more likely than not. And this means that things that we were going to adapt to somewhere by 2080 to 2100 is happening now, right? So we're really about 70 plus years behind in adaptation. So we really need to sort of like pick up the step on adaptation right now. And there's not enough adaptation financing here as well going into this. And this also then increases risks for bank loan books and et cetera, and financial systems and so on. So I think, on one hand, where you have data on the physical side, use it and adapt. And we oftentimes are pulled in to sort of help corporates come up with a strategy for water risk mitigation. On the other side, where you don't have data, and oftentimes these are huge risks where you don't have enough data, like sea level rise, basin risks, what happens if, you can see it now, the Colorado River's running dry, the Po River's running dry, there's also a problem with the Yangtze, the Rhine, and so on and so on. These are huge industrial heartlands across Europe, across China, and in America, food basins, right? So what happens if they run dry? So we're going to have to think about all these risks and manage them together. And on these basins, there's better data on the Yangtze and probably the Rhine and the Colorado than, say, the Indus River Basin, which just got completely hit by a huge flood recently, right? And so I think that, where there are huge data gaps and big risks, we need to invest more in building the data there, right? So yeah, those would be the two sort of like two-pronged strat.
And you're raising a very important point there towards about investing to acquire data, and it was going to bring me to the point of accessibility. And I see one of the questions has come in as sort of, who should pay for all of this data? You do this you run a commercial business, Jason, so I'm not suggesting you should be dropping your fees to zero, but share your thoughts on perhaps where might some boundaries be to what data should be out there and that's accessible to all, and where should people really be expecting to pay for it?
Yeah, first of all, data and technology are our bread and butter. So that's our commercial model. Yeah. And going back to your previous question, I would actually counter-argue that wherever there's business, there is data. So more data is a good thing. But interpretation of data requires technology. What do I mean by that? If we don't want too much data, then we can live a very simple lifestyle. Do we want to go back 20 years where there's no phone, there's no smartphone, there's no overwhelming data? But that's how our economy grows, right? Wherever there's more business, there's more people, there's more business, there's data. And then technology is designed to help, be it asset managers or banks or anyone to interpret this. And same analogy works for ESG, for carbon, and sustainability. I would like to quote one of our customers, a top bulge bracket investment bank that we've been working with. And I still clearly remember that when we asked about how do you define ESG data, and my client said that ESG data is anything other than financial statements. So the scope of ESG and sustainability is very broad. And the data, subsequently, the data that we're talking about is a very large and ever-growing scope. And at the same time, as I said previously, there are different angles that you can look into it. Right? So going back to your question about commercials, where to us the business opportunities are, I wanted to make it very clear that to us, our business model is not to show you the data that is already there, but rather there's a lot of data that we have omitted, that we have neglected, that we have not been able to pay attention to, or as a single individual or a firm or financial institution does not have the capability to pull them together. What do I mean by pull them together? First of all, are these data sets publicly available? Yes, there's publicly available data. There's also what we call, if you don't have it publicly available, then we can help you estimate. And if we don't even have good indicators and you cannot even estimate it, then you can directly engage the counterparties to provide the data. And then you can help them collect the data, because when we work with a corporate, just bear with me, it's not that the corporates don't want to report their data. It's simply that these corporates do not have the data themselves while they're operating their business on a day-to-day basis. They have not installed technology to help them aggregate and analyze the data. And going back to the publicly available data, but then to a lot of financial institutions and to whoever who wants to utilize these data, there's structured data, unstructured data. How do you structure them? How do you put it into meaningful form? How do you screen the data for the ones that you are interested in? And people may have come in from different angles and they would want to utilize different data points. That's more technology. That's where technology can help. And at the very end, let me go back to an analogy of, I always like to make the analogy of financial data compared to ESG or carbon data. Is financial data publicly available? Yes, they are there. especially for public companies, they're required to disclose it. And for bond issuers, they disclose their data as well. And for some of the private companies, they disclose the data there as well. But why do we still need Bloomberg? Why do we still need analysts? If it's there, then we don't need analysts. We don't need technology to predict the trend. We don't need technology to cleanse the data and put them together. So I think the availability of data is one thing, but technology can help enhance the data and process it into meaningful forms. Technology is a good tool to help us interpret this ever-growing large scope of data.
Jason, the question here, and I'll be very direct, the question's very direct, it's the case of the SME. I mean, the SME is not going to have a Bloomberg terminal in his cafe. He perhaps can't afford your service, or maybe you do have an offering. But how does the SME go about it? Is it you just need to work harder, read the sustainability reports of your suppliers and work out what your scope 3 is? Or is there an offering for the SME that's affordable?
First of all, we have a lot of SME clients, and there are two angles that I want to mention. First of all, why do SMEs want to report or share their data? Let me be honest with everyone. By nature, they don't have any incentive or motivation to share their data, right? Unless there are three angles that we can look at it, that they would like to share the data. First of all, the regulator asks them to do so. And second of all, their bankers or investors ask them to do so. And third of all, if their customers ask them to do so, which means supply chain. So when we try to engage with technology, engage these SMEs, we always try to come in at this stage, at this point in history, from the three angles that I mentioned. Whether from a regulatory angle, you need to do that, you need to report. Whether you are exporting this to Europe and the European customers ask you to share it, or simply your bankers ask you to report it so that you can get cheaper access to financing.
I mean, the European Customs Officer is going to ask you to report.
Exactly.
For the carbon border adjustment mechanism.
Yeah.
I mean, I think all three of those are absolutely drivers as to why the SME is under more pressure, which is why it's such a good question. But let me test whether my answer is any good and bring Olivier back in. SMEs, I mean, you as a bank, again, you do a lot of work with SMEs, and you also do a lot of work, like many banks, with the sort of, the big brands who procure. My sense is banks are doing an awful lot to incentivize change in supply chains. But tell us your perspective on that, Olivier.
Yes, Jonathan, on SMEs, so Natixis is more financing large corporates, SMEs is more the group and retail and BPC, but definitely that's a journey where banks are going into. The use of data definitely will be more than required, as mentioned by Jason, and we need vendors, we need data providers in order to collect information. If information or data is not available on the shelf, we need to be able to compare, because as rightly pointed out, information might be there, but is it being used? Is the data using the same methodologies? We have no idea. So hence why we need someone to collect and to make sure that methodology that is being used is the same in order to compare apple with apple. That's key for us when we design structures for clients, be it a large corporate and tomorrow SMEs, and even for retail and for individual clients, for them to be able to compare themselves and be able to compare their carbon footprint when looking at their app, on their bank app, having the ability to check what they consume vis-à-vis the average consumption of carbon from a given country.
Yeah, I think you're right, Olivier. I mean, I think if you take somebody like a big name like a Walmart, I mean, they've made commitments as to how they're going to make change, and they're only going to do that through their supply chain, through Scope 3. So they have to have that data. They have to know that, otherwise those incentivization programs don't get traction. So look, thank you for that. I wanted to just come back to change tack slightly here, because Debra raised another important point about adaptation, because we're talking a lot about emissions and the mitigation side. It's not going to be a question for you, Debra. I was going to go back to Mervyn and ask, in your analysis, Mervyn, how much do you look at how clients are either preparing to adapt where they're exposed, or looking at the opportunities from adaptation as a driver of value in their business?
Yeah, I think there's two sides to this, which is clients on our end who are looking to fund adaptation because they feel like it's something that they want to be directing capital towards. And so Blue Orchard is one of our kind of impact investing arms, is focused on kind of finding effectively climate solutions that help to adapt. And so trying to understand where we can find projects that we can finance when it comes to being able to help with adaptation to climate, different kind of physical scenarios. I think the second bit, which is I think on the adaptation, is how do we assess the potential physical risks that companies face, and what that adaptation process could potentially alleviate some of the physical risks that might come. Because I think at the moment, I think the way that in terms of some physical risk analysis is done, we look at the assets that a company might have. We'll look at the geospatial data to kind of understand, like what Debra said, when it comes to hurricane risk or what it comes to typhoon risk. But quite a lot of that analysis doesn't necessarily consider what that potential adaptation process might involve. Now, I think one challenge, though, with talking to companies and thinking about how they adapt is it's not always the company that's able to effectively adapt or do all the things that is needed to adapt. So they might be able to, depending on which exact sector we're talking about, a miner might be able to adjust the way they operate to limit some of the flood risk they face, or an electric, like let's say a electric generation company operating in a forest might be able to manage the potential for wildfires to a degree. But there is going to be a huge role for government and policy to actually go about really funding climate adaptation and managing that risk. And so I think physical risk and climate adaptation is kind of where it's a bit clearer, but I think we need to actually recognize when we talk to and think about assessing the risk companies face, what companies can do versus what might policymakers and other stakeholders have to do.
That's brilliant, thank you, Mervyn. So I'm picking up there, adaptation, natural capital, risk management. So Bénédicte, back to you with thinking about how you support central banks perhaps in their processes of assessing risks, or what sort of questions should they be asking banks? Is that something you think that is, regulators, are you seeing regulators asking themselves that question? How do I address natural capital impacts, which in a sense is sort of linked to the adaptation or adaptation discussion? Is that an area that you're innovating in?
Yeah, so I think in general, as we were saying, there is a lot of data, and if you think about it towards my example of Everest, right? There's also getting to the base camp, and in a sense, we got to base camp. So when I started looking into ESG data, actually that was during my time at the SFC, so I can exactly date it. It was 2013. I went speaking with a series of asset managers, and I asked them if they were considering ESG as a factor in their investment. And you will be quite shocked, so I will leave the names on the side, but one of the world's majors said to me, no, we're not, because we only think financial data matter, and our fiduciary duty is limited to financial data. And by the way, that point just came out again in Republican America, so that point is still not gone. The second leading asset manager said, what is ESG? So I'm saying this is 2013. It's not a long time ago. So if you think about the fact that in those less than 10 years, nearly 10 years nevertheless, we've come to having quite advanced databases. So you're one, right, Jason? But there's also Sustainalytics at the time was started up. And I know people were looking at that and going like, why are they even doing this? Why are they bothering? Because we only consider financial data. That's what people were thinking. Now we're, as at 9 years on, and I recently saw the product of True Cost, for example, and it's impressive, the amount of data. So to go back to our mandate as coordinators between the central banks, I think part of it is also to say, okay, sorry, we don't need to invent everything anymore because we're already at base camp, right? From really being at sea level, we're now at base camp, which is there is a lot of databases that actually the central banks can work with to judge the risk of the banks, right? Because at the end of the day, the banks are extending loans. And so the other interesting aspect is that those data, and this is what I was just thinking and in my mind thinking about, in fact, those are the same data across the capital markets. What a stock exchange needs are what shareholders need to make an investment in a company is the same data that asset managers are using, is actually the same data that a lender can use because it's corporate data. And it's in some quite reusable in all these different contexts. And I think that's where probably the BIS Innovation Hub can play more of a role, is to show which data already exists and then help in performing the different duties that a central bank may have in terms of aiding in the supervision of these risks.
Benedict, thank you. That's a very nice positive note to finish on, that there's data out there that perhaps we're not using, we can use it effectively. We're at time, but Benedict, I think you've made a lovely closing remark there, but I just wanted to give the other 4 panelists an opportunity for a very brief closing remark. There's a question on here which talks about innovative technology for data. So let me broaden that question to each of you and go with Debra first. What innovation would you like to see that will make the biggest difference to you?
Okay, I'm going to go slightly off piece there. I think there's enough data at the moment. From a water side, I would like to sort of see a consensus in financial valuation of that risk. Right?
Thank you. Jason.
An innovation that brings the whole ecosystem together. It's not only data providers or technology, it's all of us, all different panel speakers. We need technology to bring all of us together. Yeah.
Okay. Mervyn.
Just to say, not to add another mountain into the picture, but it's not just corporates we have to think about. There's sovereign, securitization, infrastructure, derivatives, commodities, microfinance, all that we have to, like as an asset manager, we have to think about data for.
Olivier, you get the last word.
Last word for me would be standardization, benchmarkability, having an infrastructure soon in place in order to allow all market players to have access to transparent information, standardized information, and benchmarkable information.
Olivier, thank you. Well, look, I think a great selection there of things perhaps to take away. I think the relevance of data didn't need too much elaboration, but you've heard some of that. The role of technology, not just data technology, but also we talked about geopositioning, satellite-drawn data, all of those things, Earth sort of measuring data. And then I think it's all brought together by this process of collaboration, data sharing, which goes to accessibility and enabling access so that people can make better decisions. So with that, I will draw the panel to the close with a huge thanks to all 5 panelists, Bénédicte, Debra, Jason, Mervyn, and Olivier behind me. And if you enjoyed the last hour, please join me in giving them a round of applause. Thank you very much.